Hi everyone, so in this video I'd like to explain a bit more on the generally the types of investments and markets, so investment markets that they are. Different markets to trade different types of securities, different types of investments. Now this video will just be a short general explanation. Some of the details on the types of investments such as stocks and bonds will be explained in other videos, later videos. Do check out the videos on what are stocks and what are bonds. And yeah, so this is just a general understanding of the different types of investments that they may exist and the different types of investment markets in which investors trade such types of investments. Now, let's understand the general. So you can see here, there are many different types of investments: stocks, bonds, mutual funds, ETFs, real estate, commodities, cryptocurrencies, CDs. Now, let's start with just the two main ones that I was talking about: shares, stocks, equities. They roughly mean the same thing, and bonds. Now, what is a stock? A stock is an ownership in a firm. If you buy a share, you're buying an ownership part in a firm. Let's say you buy 5 shares, then and let's say each share is worth 1% in a company, then you own 5% in a company, for example. So you're buying a share, you're owning part of a firm. You buy more shares, you become a larger owner. Bonds. Bonds are issued by governments and firms. They are known as issuers, in which investors pay the amount, the loan. So essentially, it's like a loan. If the bond is, let's say, $100,000, if it's issued by the government and the firm, investors will pay $100,000 to the issuer, the government and the firm. So it's a form of lending. The investor will lend to the issuer, the government or the firm. And this is a form of investment because the full payment amount will be returned later, and as well as interest payments on the loan. So the government and firm and the issuer will provide interest payments just like a normal bank loan. So, and which going back to stocks, how do we make money on owning shares and stocks? Like, why would you even bother owning shares and stocks? Why would you want to own a part of a firm? Now, first, some stocks provide dividends. So, some companies will pay a proportion of their profit to investors. For example, if you own a part share in the company, the company will pay their investors a percentage point of their total profit. So it sort of incentivizes people to keep onto their stock, keep onto their ownership, because there's a potential profit made, which is the firm paying out their investors. So the company will pay out their investors. Another way to earn money on stock is capital gain, so the increase in the price of the share. So you buy at a low price, you sell at a higher price, you make money from the share. Now, some shares, equity stocks are traded on classic stock exchanges that we know of, such as the New York Stock Exchange, for example, the Kuala Lumpur Stock Exchange, and it's traded between investors. So stocks are traded usually between investors on the stock exchange. Even though it's owning part of a firm, imagine it like this: it's the second-hand market where investors sort of trade their ownership between each other. And the price of stocks are determined by supply and demand. Now, in the bond market, it's the same thing. It's also traded between investors. Now, other types of investments include real estate, so money earned through rent or increments in property value, commodities such as trading gold, silver, oil, wheat, trading contracts in which you're betting on the future price of gold. For example, if you buy a contract and the demand for the gold contract increases, then you'll make money on commodities. So usually when you trade commodities, you're not actually buying and selling gold, you're trading something known as future options. So I suggest that if any of you are interested in learning more on how commodities are traded, you guys can just go online and search up how what are options called, because this will not be covered in this module. Now, for ETFs, an exchange traded fund is an investment fund that holds multiple underlying assets. For example, an ETF, commonly known ETFs are, some of you may have heard, are the S&P 500, the Nasdaq, etc. So they hold many different stocks. For example, it's a basket of stocks. When you buy a share of a company, you can open up the stock exchange and buy individual shares. Let's say I buy Apple shares, I buy Google shares. But the ETF comprises of many different shares of a company. So you just by buying one ETF, you can buy many different types of shares, many different types of investments. Now, in terms of types of markets, there are three types. There are three and more types. I'm just going to show you guys three. So we got the stock market, as mentioned earlier, is where stock market, where the shares of companies are bought and sold. Price is influenced by demand and supply. So this will be explained more on the stock video, on the what are stocks video. Please do check it out. And what's the purpose of having trading on the New York and the stock exchange, such as the New York Stock Exchange, is to help companies raise long-term finance and gives investors a chance to grow their wealth. So buying shares, you become a part owner of the company. Now, similarly, bonds are traded on the bond market. Price changes are determined usually by economy-wide interest rates and the credit risk of the issuer. So let's say a government may have less risk on defaulting on paying back their loan compared to a private firm. And a bond market so it sort of allows governments and firms to borrow money and provide investors with a stable income. So when you buy a bond, you're lending money instead, and you're not owning a part of the company. Now, in the commodity market is usually where we trade on contracts that determine the prices of raw materials and natural resources. So different types of commodities are listed here. So often, as I mentioned earlier, is traded using future contracts. So there are contracts which are agreements to buy or sell later. Let's say the agreement is to buy the gold at $50, but the price of gold has risen to $60. This contract to buy so cheap at a lower price compared to the current market price increase in demand, so the future contract will increase. So do check this out if any of you guys are interested. And it allows investors to speculate or diversify. So speculating on the actual price of the commodity, and the value of the contract and the value of the commodity comes from the physical, tangible aspect of the good, not based on companies or debt. Thank you.